George Soros. You've probably heard of him as the man who broke the Bank of England. But behind that legendary trade, there's this really powerful, almost radical philosophy that just turns modern economics on its head. Soros says that markets aren't these predictable machines at all. Instead, he sees them as complex ecosystems, driven by a strange and powerful loop between our own perceptions and the reality we end up creating. To really get how he made his billions, you have to get how he thinks. So let's break it down. So here's our game plan. First, we're going to challenge that old-school idea that markets are perfectly rational. Then we'll dive deep into his core concept, something he calls the reflexivity loop. After that, we'll see that loop in action with his most famous trade. It's an incredible story. Then we'll look at the unique mindset you need to have to trade in such an uncertain world. And finally, we'll dig into why Soros's ideas might just be more important today than they've ever been. All right, let's jump right in. First up, markets aren't machines. For decades, the dominant economic theories basically treated financial markets like they were something out of a physics textbook, governed by predictable laws, always moving towards balance, and filled with people making perfectly rational choices. Soros looked at that neat and tidy picture and just said, nope, that is not the reality I see every single day.
So this is the central question, right? For the better part of a century, classical economics answered this with a big, confident yes. The theory was that prices reflect all the available information, and the market, kind of like a pendulum, will always swing back to a stable, balanced state. But if that's really true, how do we explain things like massive speculative bubbles, or these long trends that seem completely disconnected from reality, or those sudden, violent crashes that come out of nowhere? Soros believed the classical model was missing the single most important variable of all, us, humans.
This slide really lays out the two completely different worlds. On the left, you've got that clean, textbook world of classical economics. Everything's in equilibrium, information is perfect, decisions are rational. It's a machine. But on the right, you have Soros's reality, which is, well, it's a lot messier. It's more organic, way more dynamic. It's not about a pendulum swinging back to the middle. It's about feedback loops that can spiral out of control. See, in his world, prices don't just reflect information, they reflect our flawed interpretations of that information, all our hopes, our fears, our biases. And that's what creates these powerful self-reinforcing trends that can push markets way out of balance. The key takeaway here is that Soros saw markets not as some mechanism you study from a distance, but as a living, breathing process shaped by the quirks of human psychology.
So if markets aren't machines, then what are they? Well, that brings us to Soros's big idea. Section 2, the reflexivity loop. This is his greatest contribution, and funny enough, it's an idea that didn't come from economics, it came from philosophy. To really get reflexivity, you have to go back to Soros's college days at the London School of Economics. He studied under this philosopher, Karl Popper. And Popper's big idea was something called fallibility. All it means is that our understanding of the world is always inherently incomplete and flawed. We never have the absolute truth, we just have theories that we haven't managed to disprove yet. Soros took this really deep philosophical idea and applied it directly to the financial markets, and he came to a pretty radical conclusion. If our perception of the world is always flawed, then market prices, which are just a reflection of our collective perceptions, must also be inherently flawed and biased.
And that brings us right to the core definition. Reflexivity is this constant two-way feedback loop. It's not a one-way street where we're all just objectively watching what happens and placing our bets. Not at all. Soros argues that we are active participants. Our beliefs, our biases, they lead us to buy or sell. That action moves prices and actually influences real-world events. Then, those events change the underlying reality, which then feeds back and changes our original beliefs. We don't just interpret the game. Our interpretations literally change the rules of the game as we're playing it.
And this is a brilliant way to see that cycle in action. Let's just walk through it. It all starts with a perception, right? Let's say a collective belief that some new technology is going to change the world. That leads to step 2, action. People start piling in, buying stocks in that sector. Now this action shifts reality. Stock prices go up, which suddenly makes those companies look way more successful. They can attract better talent, they can raise money more easily to actually fund their growth. This new, improved reality then reinforces the original perception, creating an even more bullish belief. More people buy in, the price goes higher, and the loop just keeps going, creating a massive, self-reinforcing boom. And of course, this loop is just as powerful on the way down, which is exactly why market crashes can feel so sudden and so brutal.
Okay, theory is great, but let's see how this thing works, where the rubber meets the road. This brings us to probably the most famous financial trade of all time,
and the perfect example of Soros putting his framework into practice. Section 3, Breaking the Bank of England.
So here's the setup. Back in the early 90s, the UK decided to peg the British pound to the German mark. This was basically a public promise from the government to keep the pound's value within a really tight range. But by September of 1992, the UK economy was in trouble, and traders around the world started to believe that this peg was just not sustainable. Soros saw that the government's political promise was clashing with its economic reality. The perception of weakness was starting to build, and on September 16th, a day that became known as Black Wednesday, Soros and his fund placed an absolutely massive bet, a $10 billion short position against the British pound.
And this quote right here, this is the whole game. Soros's trade wasn't just based on some spreadsheets and macroeconomic data. The real bet was on reflexivity. He understood that, yeah, in theory, the UK government could defend the pound, but only for as long as the market believed they could. He was betting on the perception of the market. He knew that once enough traders started to doubt that peg and started selling the pound, the government's defense would become impossibly expensive. The market's belief was the real fundamental here, and once that belief broke, reality was forced to follow.
$1 billion in a single trade. This wasn't just getting lucky. This was the financial result of having a better intellectual framework. Soros didn't just analyze the numbers. He analyzed the market's collective mind, and he saw how its flawed perception was about to create an entirely new reality. He didn't predict the future. He just understood how the present belief system was about to collapse under its own weight.
An incredible success like that, it's not just about understanding markets. It's about having a very specific mindset for navigating them. And that brings us to our next section, trading with fallibility. This is all about how you turn that philosophical idea of being flawed into a practical financial advantage.
So Soros's philosophy translates into this really powerful trading psychology, and it's all centered on one core idea. You are going to be wrong, a lot. He thinks of every trade not as a statement of fact, but as a hypothesis that he's testing against the market. If the market proves your hypothesis right, great, you can add to your position. But if it moves against you, that's not a personal failure, it's just new information. It's the market telling you your hypothesis is flawed. The real key is to avoid emotional attachment. The second you fall in love with an idea, you lose the ability to see when it's wrong,
and this leads to a completely different way of thinking about risk. I mean, this statement is just so profound. Most traders think about risk in terms of how much money they have on the line. Soros just redefines the whole thing. The real risk isn't being wrong, it's staying wrong. A big position in a correct idea is a huge opportunity. But even a small position in a flawed idea that you refuse to let go of because of pride or stubbornness, that's financial suicide. The greatest danger is your own ego when the market is telling you you're wrong.
So what does all of this mean for us today? In a world that's dominated by algorithms and high-speed trading, are these ideas about human psychology even still relevant? Let's take a look at his enduring legacy, because I think they might be more important now than ever before.
The core difference really comes down to this. Soros was a huge critic of what he called market fundamentalism, this kind of blind faith that markets, if you just leave them alone, will always fix themselves and lead to the best possible outcomes. Market fundamentalism is really an ideology of stability. Reflexivity theory, on the other hand, is a framework for understanding instability. It accepts that because markets are driven by flawed human beings, they are naturally going to have these collective manias, panics, and deep imbalances that don't always correct themselves.
But I know what you might be thinking. What about all the computers? Don't algorithms and high-frequency trading make markets more rational? Well, Soros's framework would say no. In fact, reflexivity might be even more important now. Why? Because who designs the algorithms? People do. Who programs their rules and sets their goals? People do. All those biases, those narratives, those collective beliefs that drive human behavior, they're now just hardwired into our automated trading systems. The feedback loops might be faster and more powerful, but they're still there, and they're still driven by the exact same human psychology.
And so this brings us to our final and I think most critical question. This is really the ultimate takeaway from Soros's entire philosophy. It forces us to stop asking, what is the true value of this asset, and start asking a much more powerful, more relevant question. What is the dominant belief system driving this market, and how is that belief shaping reality? Whether it's a belief in the infinite power of AI, or the inevitability of a recession, or the long-term value of Bitcoin, that collective perception isn't just a reflection of reality, it is actively creating it. And understanding that loop, that's the real key to navigating the markets of today and tomorrow.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description. Stay well.